Hello everyone. Today I'm going to start a new course named as Risk Management. This course is extremely important for all those students who want to pursue a career in finance. Therefore, it is important for all the students who are pursuing BBA, MBA in finance and others. Now, today in this lecture, I am going to cover some topics. First, let us see what are those. The first objective or the topic that is covered is define risk. So after the completion of this session, we all will be in a position to understand the meaning of risk. Next topic is relationship between risk and return. What is the relationship between risk and return? Whether they are positively correlated or they are negatively correlated. Increasing in risk will lead to increase in return or vice versa. That we'll see. We'll find out in this session. The next topic is risk premium. What do you mean by the term risk premium? We'll define and we'll try to understand the meaning of risk premium through this session. The last but not the least of today's lecture is risk-free return. The meaning of risk-free return. What is a risk-free return? Are there at all any return which you can say risk-free or there are not? So all these questions will be answered during the session of today's lecture. Let's move forward. Now, what is risk? This is expected return. First, let us understand what you mean by expected return. Whenever an investor, an individual one or an institutional one, invest in some investment avenue, obviously some kind of return is expected from that particular investment avenue. That return is termed as an expected return. Now, actual return. What do you mean by the term actual return? Actual return is the return that an investor, whether individual or institutional, that investor gets after the completion of the investment tenure. So this is the actual return that he gets. And the first one is the expected return that he expects from the particular investment before investing. So we can say that when there is some kind of differences between expected return and the actual return, then we say that risk exists. Yes. When there is a chance that the actual return may vary from the expected return, we say there is risk, right? So we can define risk as the chance or likelihood of an outcome or investment's actual return being different from the expected outcome or return. Then we say that risk exists. So in short, we can say risk is actually the likelihood of a loss, chance of a loss, possibility of a loss, or probability of a loss in different terms. Our next topic is relationship between risk and return. Let us have a look. The basic objective of every individual or organization is to maintain balance between risk and return. That is, a trade-off should be maintained between risk and return. This means when any individual or an organization is taking up any extra amount of risk, that extra amount of risk should be compensated through an extra amount of return. This is termed as trade-off between risk and return. All individual or organization should avoid taking unnecessary risk which is given no extra return. This should be the basic objective. Now, you can say risk and return, they are positively correlated. Now, what do you mean by the term positive correlation? Positive correlation simply implies that if risk is increasing, return should also increase along with that risk. Otherwise, the investor should not take up that extra amount of risk. Similarly, if the risk associated with a particular investment avenue is less, then obviously the return that is associated with it is less. So we can say, in short, that risk and return are positively correlated. The greater the amount of risk an investor is willing to take, the greater the potential return. Otherwise, you can say in a very simple way that why the investor should take up that extra amount of risk. There is no interest at all for the investor to take up that extra amount of risk with no extra return. So it's very common thing, right? Now, investors need to be compensated for taking an additional risk, obviously. If they are not compensated, you can say that that investor should not take up that extra amount of risk. For example, I'm giving a very simple example. If a person is asked to jump from the first floor of a building and from the top floor of the building, and the compensation being 10 lakh each time, what do you think? No. Question is, should that person take up both the deal or take up the deal to jump from the top floor of the building when the compensation is same for the first floor as well as for the top floor? You can say the person should not take up the deal of jumping from the top floor. Rather, he will take up the deal of jumping from the first floor, right? Because risk is less, compensation is same for the both. There is no more extra compensation that is being paid to the person for taking up that extra amount of risk of jumping from the top floor, right? But let us imagine that this deal is something different, that if you jump from the first floor you will get 10 lakh, if you will jump from the top floor you will get 1 crore. Now tell me, what should the person do? The person may take up the deal of jumping from the top floor of the building because an extra amount of money has been given to him for taking up for this additional amount of risk. That's it. What is that extra amount of return? That extra amount of return is around 90 lakhs more, right? Because there is a lot of risk which is associated with the person's life. Life risk is there as well as others, you can see, right? When he will jump from the top floor. So that extra amount of risk is the risk premium. We will see in the next slide. This is risk premium, right? That extra amount of risk that you get for bearing that extra amount of risk is termed as risk premium. It's very important. So in our previous example, you can say 90 lakh is the risk premium that the person actually gets. See, extra risk, this is extra return, which is termed as risk premium. Risk-free return. Now let us see whether there are any kind of risk-free returns or not, or all returns are actually associated with some kind of risk, right? Risk-free return simply implies returns that you get for bearing no risk. That is return that is earned due to investment over a period of time. So you can say that there is no risk, so there is no compensation for bearing any kind of risk because there does not exist any kind of risk, but you invest your money for a period of time, right? So you get that return from the investment over the investment tenure. For example, you can say risk-free returns can be a government treasury bill. You can say it is the one of the most safest and risk-free return. It is a very good example for risk-free return. We usually take the return from a government treasury bill as the benchmark for the risk-free returns. In this diagram, you will see when there is no risk, you get a corresponding return for that no risk, but it is this return is due to the investment over that period of time, right? That is termed as risk-free return. Now, as risk increases, extra risk, you see, you obviously get an extra return for bearing that extra risk, which is termed as risk premium. Now, before I end up today's session, there are some questions that I want to ask my friends so that in the next session we'll try to answer those questions. You have to go back and do some homeworks for today's session. You have to understand what I meant from risk, what I meant by relationship between risk and return, what do you mean by risk premium, what are risk-free returns, these four topics that we covered in today's session. My question today is, what do you say when the actual return is more than the expected return? This is a question that I'm throwing towards my audience. You have to think about that. Definitely you expected more, your actual return was less. It's alright, you can say there is a risk because you have not got your expected return. But if your actual return is more than the expected return, what do you say in that case? Do you say that there is a risk? What is that particular term said to be? My second question is, if the return from a government bond, suppose it is 5% is the return from a government bond, the return from a stock is 20%, then what is the risk premium? You have to think about it. And in the next session, we'll deal with these two questions. We'll give the answers about this. Now, before I end up today's session, let me throw some light on my next lecture's topics or objectives that I'm going to cover in my next lecture. In my next session, I'm going to cover the different types of risk, like market risk, interest rate risk, inflation rate risk, and many more. Another category of categorizing the different types of risk is systematic risk and unsystematic risk. So what is it? That also will see. Next, measurements of risk. That means what are the different ways in which you can measure risk? We will also do some hands-on on this. How you can measure the various risks and different risks. Risk can be future risk as well as historical risk. Risk which is associated with some chances of possibility, probability. We say that that is future risk. And already occurred risk is termed as historical risk. In that case, what will be the measurements? How we can measure? Different tools and techniques we can use for the measurement of risk. Next topic to be covered is different terms that are connected with risk. We'll see what are the different terms which are very important for all of us to have a very clear idea whenever we are dealing with the course risk management. What is our risk management process? Every organization individuals as well, they take up some kind of process to minimize this, because this is a very crucial problem. We deal with risk everyday life, right? So this risk management process have certain stages, certain strategies, certain principles. We will look up what is the different stages that are involved in risk management process, and how to deal with the different stages, in fact, and we'll see the step by step process, how the strategy and all that, right? In details we'll see. The last but not the least one is the different ways of managing risk. What are the different ways of managing risk? How you can manage the risk, like prevention, avoiding, reduction of risk, retention of risk, transfer of risk. All these are the different ways of managing risk that we will discuss thoroughly and in details with each and every practical situation examples. Uh, so before that, thank you. Thank you for hearing my lecture for today. See all of you tomorrow. Thank you very much.